So a lot is happening in the markets so far this year, and our investment committee met last week and we compared data from major institutional money managers and also some other top advisors. So here are some notes for you to know and to share if you'd like. We see the party, if you will, in the markets possibly continuing longer, but we're starting to feel that euphoria in the market coming a little bit closer, and that typically signals correction. Now, remember, corrections are very normal and they happen almost every year in the stock market. And earlier this year, we actually shifted some allocations in our discretionary accounts from growth stocks, which had a great run last year, to more value stocks. And so far this year, value stocks have significantly outperformed growth stocks. But as you know, past performance is never a guarantee of future results. And I had to say that for my compliance department, so you're welcome, compliance. So we recently added to our value position through companies that are focused in energy, and we're looking at some alternatives for some of our bond money as bonds continue to struggle in this low interest rate environment. We remind all clients that even though bonds are very blah, if you will, these days, we own some bonds always because of risk management, right? And some downside protection during the bad markets. Our sources feel that inflation is and will continue to creep in over this year and into the coming years with all of the government spending. So we're monitoring this closely, and this is another reason that it's so important to own stocks. Gold is suffering primarily because of cryptocurrency becoming a competitor for investors who want money outside of traditional stocks. And we've really never used gold as a long-term investment in our models. That's really more of an FYI. But speaking of cryptocurrency, we continue to spend a lot of time learning about this area. But remember, it's still a non-regulated asset class that is very risky, and investors are and they can do it on their own. However, we do realize it's here to stay, and so we're staying pretty progressive on the learning curve. Now, there's much fear circulating about the upcoming Biden tax plan and tax increases. And while we see this as non-favorable to the market, it's likely going to be negotiated, probably not as bad as we're hearing currently. However, if the Democrats get more seats in 2022, then it's likely that the more aggressive tax hikes and government spending will kick in. The economy is starting to sense the pent-up demand for spending on things like goods and travel, which is no surprise, and that's part of the temporary party that I've referenced earlier. Summer is near and nearly half of U.S. adults are vaccinated, and the Biden tax plan is sounding like it's not going to be as aggressive as anticipated. All of that being said, our firm and team is all over this, and that's why our clients have us on their side, right? I just like to share the bigger picture thoughts for your knowledge and really to see if it maybe triggers any questions or concerns that you may have for us. So do this for me. Enjoy the summer and this nicer weather and come see us as you feel comfortable. We'd love to have you in the office. And I leave you with a couple of great market quotes. Far more money has been lost by investors preparing for corrections or trying to anticipate corrections than has actually been lost in the corrections themselves. I like that one, it's very true. Here's another one. It isn't being in the next 20% market correction that scares me. It's being out of the next 100% advance. Also very true. So as always, stay focused on the things that matter, like creating memories and experiences, doing things you love with the people you love. And I'll talk to you soon.